It is complicated and it is big and it is significant, but in all things China, there are unique China solutions. But before we go to the solution, maybe we can deal with the problem. So if we go back 5-7 years ago, China was running into a deflation concern, similar to what we are seeing today. And we saw money starting to leave China, capital flight, which put pressure on the currency. Now, what the government did in 2015 and 2016 was very clever. They said, we need to increase demand in the economy and reduce supply to avoid a deflation trap. And so what they did is they cut capacity in the old economy, so steel and all materials and manufacturing. But you can't just do that because it would end up cutting income because you have high unemployment. So what they did was to inflate the demand side of the economy by putting a whole lot of credit into the household sector by stimulating the property market. And so from really 2015 to 2020, 21, you saw a gigantic boom in the property sector, very strong property prices and a lot of speculation and investment that was driving demand because there was effectively an implicit guarantee from the government. They said, we have to save the economy. We want the household sector to buy property. That's how we're going to save the economy. And then we hit 2021, and over the previous years, what you'd seen is the build-up in household debt in China between 2015 and 2021 was the same as America going into the global financial crisis, but the Chinese economy is a smaller economy. And there was just too much credit going in, and it was becoming a systemic problem. So the government said, enough's enough. We have to address this problem. And they put in very restrictive policies to stop the asset bubble. Now, it took a while to work, but eventually domestic investors heard it loud and clear. And over the last 2 years, we've seen housing sales fall 60%. And that has put enormous pressure on the developers. These developers, which had benefited massively from the credit creation that was going into the sector, suddenly no one's buying their properties. And so they're now running into financial problems. What we are seeing today in China is the government is starting to try and stabilise the situation. And I would argue that after a 60% fall in housing sales, you're at a level of demand that we're getting closer to a natural level of demand where there's no speculation, there's no investment. It's just people need homes, on a regular basis and like to upgrade. And so we're at this very critical junction now where most likely going to see some stability, but that doesn't mean these property developers which have overinvested and overexpanded with high leverage are necessarily going to survive this. This is not specific to two companies. There are a lot of companies that were doing the same thing, and even companies with state backing in this downturn look like they would be beneficiaries of this process, particularly private sector companies coming out of the space, have also faced challenges. So this is a fairly universal problem. We see the headlines in the newspapers here because the two biggest companies are under problems, but there's been a much more widespread problem than just those two companies. It's really interesting because around about a third of the economy was housing 2 years ago, a gigantic part of the Chinese economy. And that housing market is now halved in size, or more than halved. So you've taken away a very big tailwind from China and turned it into a headwind. But countries or companies or sectors that were supplying into that housing sector, that investment boom, would also, in theory, be suffering. Now, iron ore is an interesting one because it obviously goes into steel, and steel goes into residential and other types of property investment. But what we've seen this year is actually iron ore prices have held up, steel prices have held up in China, and the weakness in property is actually being offset by investment in other areas in China. And under the current 5-year plan, China sets these long-term plans, there is a desire to boost investment and exposure to things like renewables and electric vehicle supply chains. And what we're seeing is steel demand is actually holding up pretty well, even though housing demand has collapsed because people are building more plants within solar or electric vehicles or other forms of renewable energy. And so Australia has been fairly fortunate, I think. I think going back 2 years ago, if you'd said the housing market was going to more than halve, I think you'd be worried about our iron ore exports. But those exports have been replaced by other new sources of demand in the economy. The reality is the macro is dominating things at the moment, but below the surface, inside the market, at the company level, there's still opportunity within that. We would say the healthcare sector is one that China needs more healthcare, as an example, and we're seeing some opportunities in that space. On top of that, there are certain niche areas of consumption which are actually still doing very well. Only about 15% of Chinese people have passports, and we're seeing post-COVID a very strong recovery in international travel, as an example of that. So things related to travel and entertainment, we also see opportunity. We own the largest travel-related company. It's expanded its market share during COVID because the smaller players have tended to fold when travel was restricted. And so they've come through the downturn in a very strong position, and margins now are actually higher than what they were before COVID. Domestic travel has been very strong, but now that the borders are opening, what we are starting to see is a shift away from domestic travel to international travel. And for this travel-related company, the dollar margin on a person going overseas is actually higher than for a traveller staying domestically. So we do see the next couple of years, as demand comes back for international travel, we do see a lot of growth left.